Hi, good morning. You're here with Zoe Arthurs on Business Basics. Now, hopefully you've managed to catch up with part one of break-even analysis. If not, not to worry, we're going to move on to part two now, which is going to be focusing on the break-even chart. Now, what we covered in part one was how to understand the difference between total costs and total revenue. We also looked at things like fixed costs, how a variable cost is linked to production. We also talked about how to identify when your business is making a loss or a profit, and that is illustrated by your first screen, which is the screen that we left your previous part on break even on at the bottom. So just to recap for you, for those of you who haven't seen part one yet, when your business is making a loss, you are actually recording your business as not making enough profit or enough revenue to cover its overheads or its costs. Now, this is displayed on the table in front of you in brackets in red. So what's really important is that you understand, whether it's you in your financial recording or your accountant who's using this terminology, that any losses are often marked with the use of a bracket. Now, as you can see, going into month 3, our total costs and our total revenue have now equaled, which is where your business is now at break-even point. Now remember, break-even is where you are not making a loss, but you are also not making a profit. So it's at that zero value point, okay? So it's at that point where you're moving into the realms of profitability in the next, hopefully, couple of months, but you're not quite there yet. So there's a website I just want to signpost you towards. It's called printablepaper.net, and what that does is it will allow you to print off chart paper should you want to have a go at doing your own break-even chart. It's completely free. It downloads it into a PDF, but it does mean that you don't have to trawl the stationery shops for your chart paper. So hopefully that should help you a little bit. So let's move on. So there are a couple of other terms I need to make you aware of today. One of them is the margin of safety. Now, this is how much actual output, so output is the amount of goods you have to make, is above the break-even level. So it's basically described as anything after your break-even point is known as your margin of safety in terms of the amount of goods that you are producing. So if we were to calculate this, we would calculate this as our actual output level, so how much products we're actually making, we're producing, minus our break-even level. Okay, now we know how to calculate break-even. We've done that previously. And if we use the very crude example below, our t-shirt break-even, we know, looking at previous examples, is 2,000 t-shirts. So if we assume that we're only going to be able to make 3,000 at our maximum production, our margin of safety is 1,000 t-shirts. So we've taken one from the other, and that will give us our margin. Okay, so that is where our business has moved past the break-even point. We're now into the safety zone of business, and we are now moving into the realms of profitability. So as I said to you in part one, there are two ways to calculate break-even. One is via the contribution method, which we've obviously gone through, and we've worked out how to work that out. So we've looked at total contribution and contribution per unit. And remember that contribution is how much money you have after producing your product and calculating your selling price. So you would do your selling price minus your contribution, your selling price minus your variable price will give you your contribution to your overheads. So we've looked at that method, but the visual representation can be done in a chart. And this is where you will need your printable paper, so your chart paper. And it will allow you to give your bank manager, if you're going for a loan, a visual representation of what your business will look like. Now, as I said in part one, remember, break-even is only a prediction. So you are only guessing at this stage about the amount of sales. And if we went back to the table, we can see that in our first month, we haven't managed to sell anything. So actually our fixed costs are more than we are making in revenue. So break-even should always be read off the horizontal axis, okay? So vertical axis is straight up, horizontal axis is flat. and therefore expressed as a number of units. So across the bottom of your break-even chart, across your horizontal axis, this should always be expressed as a number of units. So in this example, it will be 2,000 t-shirts. So you may want to go up in steady increments of 250 or 500 across the bottom. Your vertical axis is also known as your total costs and revenue. So it's the two added together. So what you would usually do is calculate the maximum amount of units you're going to produce. So say, for example, 2,000 in this case, and you would multiply that by your selling price, and that will give you your maximum revenue. That there will be the highest point on your vertical, and you will label that total costs and revenue. So, as I said, remember to always label your break-even charts. It shows that you understand the concept, and it will also help whoever you're looking at or you're presenting to, as I said, perhaps a bank manager, understand what it is you're trying to get across with your visual representation. So as you can see, bottom left-hand corner on any chart always starts at 0, and remember to always include the units, i.e. the pounds in this case, in your costs and revenue. So if you are watching this overseas, ensure that you do it in your own currency to be extra clear. So the first line we are going to put onto our break-even chart is another horizontal line. Now this horizontal line, if you've watched part 1, is known as your fixed costs, okay, your FC. Now we know it's a horizontal line because your fixed costs stay exactly the same. Regardless of the amount that you are producing, this line will always be horizontal and it will always remain identical every single month, regardless of the amount of units that you are producing. So the second line we're going to put on is your variable costs. Now this one will start from 0, because if you're not making any goods, then remember your variable costs are linked to production. So if there are no goods to be made, you're not going to actually have to it's not going to cost you anything. So this one will be a steady incline based on the amount of units. It will go from 0 up to the highest point. So if we use 2,000 t-shirts as an example, your variable costs may increase dramatically based on the amount of production or raw materials that you need to produce those items. So just to recap, FC on this chart is your fixed costs, VC is your variable costs. Now, if you remember from part 1, in order to calculate our total costs, our TC, we had to add together our fixed costs and our variable costs. Now, quite often in break-even, it's a really simple mistake to make, but a lot of people always assume that actually all costs start from 0. Now remember, your total costs are the two costs added together, which is why it will always start at the lowest point on your fixed cost line. So total costs doesn't ever start from 0. It will always start from your fixed cost line. So you're adding one on top of the other, okay, which is illustrated here in TC. Now at that point, you can either remove your variable costs or you can leave it on. It's entirely up to you. But the final line that you want to be able to draw onto your profit and loss diagram is one that actually we're probably most interested in. And this is your total revenue. So this line will go from 0 because, as I said, if we're not producing anything, therefore you haven't got anything to sell, and therefore you're not going to get any money into the business in terms of sales of goods. So your total revenue line will go from 0. It will be directly related to the amount of units that you are producing. So and your selling costs. So if you're selling 10 units, etc., at £11, and then 20 units at £11.50, hopefully what you will see on a break-even is that your total revenue also increases. Now, at this point, you can see that two lines will cross. And this is where, if you remember from part 1, your total revenue and your total cost line equal your break-even point. So if you were to look towards the centre of the diagram, where the two lines cross is where your business is now actually crossing over at the break-even point. So you can see it illustrated there by an arrow. Now, the dotted line, previous terminology that I introduced you to at the beginning of this screencast, was margin of safety. Now, from our break-even point, if we draw a dotted line right down to the units at the bottom, as you can see illustrated, everything to the right of that dotted line is your margin of safety. So you've reached your break-even point. Your business isn't making a profit or a loss, but it is actually now moving into the realms of profitability. And I'll show you how that's displayed in just a second. So remember, when you're doing your break-even charts, to label every single point. So you've got your break-even point on there, label it really clearly, label your margin of safety, and also show your bank manager how many units by that dotted line, that margin of safety line, you have to produce in order to reach that break-even point. As I said in screencast 1, it's really important that actually you understand how many items you have to sell to make a profit or reach your break-even point. And it's really good for setting yourself milestones and goals in business plans and showing your bank manager, if you are, as I say, going for a loan, that you understand how much is involved or how many units you have to sell in order to cover your costs, which will be a key question that they ask you. So if we have a look here at our completed diagram of our break-even chart for t-shirts, you should hopefully, now we've added some numbers, and remember these are only arbitrary figures, be able to see how a break-even chart will look. So the triangle, which is illustrated here, is your profitability. So anything in here, this is where you're making your profit. So at this point here on this diagram, if we were to illustrate our margin of safety, it would go up and down here. Our break-even point is simulated here, and our profit is anything between the total cost line and the total revenue line. So it's that triangle there. Now, of course, with any financial recording, there is always going to be changing variables, and businesses should treat break-even with a degree of caution. Now, please remember, break-even is a prediction. You are trying to predict how many items, and it will only work if you have one product line. Now, that said, you can have multiple product lines, but you will have to probably, in all honesty, do several different break-even charts, okay, just to allow for accurate recording. It's also based on the assumption that costs and revenue will be static. Now, we know in any business that sometimes we have to entice new customers into the business through discounts, and this won't allow that. Your production and your raw material costs may fluctuate. Again, your break-even chart won't show that either. So just bear in mind that there are a couple of variables. You're also advised to consider that there might change and possibly look at a number of scenarios. So variables can obviously change for the better or worse, we know that. So think about the variables which might change. Our fixed costs. Landlord could put rent up, council tax could increase, bank charges may increase, maybe management want a pay increase, salaries increase, perhaps there's a downturn in the economic market and for whatever reason, your business gets flooded. There is a huge amount of variables involved. New competition may enter the market, and positive word of mouth puts demand up. So remember, it's about understanding your customer, another screencast we'll be covering, and making sure that actually you are able to understand who that customer is, price your product accordingly, and ensure that you've considered all the variables. So these are variables you're going to need to consider and illustrate that you understand may happen in your business plan. Now, I just want to close by giving you a couple of strengths and weaknesses of break-even, just to really cement our knowledge. A break-even will allow your business to calculate the minimum number of sales needed. It can calculate the level of profit or loss at different levels, and it will, as I say, provide you with a target. As I've said throughout both part 1 and part 2, it is based on predicted costs and revenue. And as we know from the previous slide, variable costs and fixed costs can change. It also only indicates the number of sales needed, so it does not ensure actual sales will materialise. So again, remember, it is only a predictive tool. So just to recap and really finish off break even, I want just to confirm that what we've learned. So in part 1 and part 2, we've had a good look at analysing financial performance. We've had a look at how to construct and interpret break-even charts. We've had a look at how to calculate and illustrate a break-even chart and the effect of change in price and output. We've had a look at the values, so strengths and weaknesses, and we've also identified how break-even can be used for financial decision-making and planning. I hope you've enjoyed the video. Please subscribe to the channel so that you can see when our next video will be coming up. I hope you have a good day and look forward to seeing you soon. Thanks, bye.